Nilesh Shah, Deputy CEO of Axis Capital, joins us now. Nilesh, finally, are you breathing a sigh of relief? Because every time Infosys numbers have come out, Nilesh, you've defended the company. Looks like your opinion is coming true.
Number one, how many times you can get a blue chip company like Infosys at lower than average market valuation? Second, while everyone was looking at the future, no one looked at the past where company was still delivering 15-20% rupee earnings growth year on year. Third, yes, IT is going through tough phase, but then in tough phase, good companies try to cover costs, and hopefully those cost cutting measures in terms of better utilization of bench will all reflect into the earnings going forward. More importantly, we have seen Infosys underperforming markets this year quite significantly. Hopefully next year it will be turn of Infosys like Maruti Suzuki last year, where it could be the dark horse.
So do you think Infosys could be the dark horse for 2013?
Definitely. We obviously have to go through the earning results in details, but clearly 2-3 things which we need to keep in mind about this results. One, there was Hurricane Sandy in this quarter. We don't know how much it impacted Infosys billings. Second, there was a holiday season like last year, but probably there was a little drop in number of billable days. So is this quarter impacted a little bit by certain unnatural events, and hence probably next quarter's earnings have been upgraded and we could see that trend continuing. Eventually you are buying Infosys at about 13 times FY14 earnings. That's significantly lower than the broad market valuation.
Let's keep Infosys aside. Let's talk about broader market. And since we are discussing expectations, do you think this time around expectations from markets are very high, because just about everyone on the street is convinced that 2013 will be a good year for us?
I think it all depends upon from which point of view you are seeing. In rupee terms, probably we are nearing all-time high. In dollar terms, we are still 30% lower than all-time high. If we are looking from India point of view, against potential 8% growth, we will grow at about 5.8%. That's probably a bit disappointing. If you are looking from a global point of view, here is a country whose monetary policy is tight, whose fiscal policy is not as extravagant as someone else, and yet is delivering 5.8% growth, and in FY14 it will be even higher. So it depends upon from which point you are talking. If you are looking from macro point of view, you will see markets running ahead of economic fundamentals. If you look from sentiment point of view, you will believe that fundamentals will eventually catch up with the market and help market continue upward march. So it's a blend of optimism versus pessimism, and certainly the flows does indicate that FIIs are more optimistic about India, and probably domestic retail investors are a little less optimistic about India.
Now let's keep Infosys aside and let's talk about IT. 2012 has not been such a bad year for the IT sector per se. HCL Tech, TCS, they've been relative outperformers. Do you think 2013 could be a reversal, in the IT space, where the performers they start coming down and underperformers they could start catching up? What I'm trying to gather from you, Nilesh, is that how different will be 2013 from 2012 for large, IT stack, for large cap IT stocks?
One thing we have to keep in mind that in 2012, while rupee virtually remained more or less the same, the benefit of weaker currency was not reflected in the most IT companies' results because they were running 6, 7, 12 months hedged position. FY13 will see the benefit of weaker rupee getting reflected into the results of the IT sector. Second, if we look at the interaction which we had with IT clientele in our sector, the deals which are coming for renewal is probably at about $120 billion, 10% plus than the $102 billion deals which happened in FY13. The third thing on the discretionary spend, where we don't have a handle right now, but hopefully if US and Europe are in a stable condition, the discretionary spending will increase, or at least will have some marginal uptick. put weaker currency, discretionary spend probably going to increase in second half of FY14 and more number of deals coming for rollovers. All this bodes well for the volume growth of the IT sector, and that should be reflected into companies across this sector range and not just few companies. Will there be few disappointments? The answer is yes, but will the quality companies across large and mid-cap space be able to outperform the market this year? The chances are far better.
Nilesh, so after a 25% run-up for the year gone by, how does a long-term investor judge that all the good news is not in the price?
Unfortunately, yes, most of the good news is there in the price. Clearly, fixed income markets have rallied by 30 basis points, which means interest rate cut is expected on 29 Jan by both the fixed income and the equity market. Second, the IIP numbers or the automobile numbers or the airline passenger numbers, these are all pointing towards a slightly weaker economy. The earnings growth for third quarter of FY13 also is going to show a volume growth which is probably lowest in last 6-7 quarters, and the earnings growth is also not going to be more than double digit. It will be in single digit. So clearly sentiments are today running ahead of the economic fundamentals. There is expectation that budget will maintain fiscal deficit at 5.1% for the FY13 and 4.8% for FY14. So market today undoubtedly is running on hope, on better sentiments and on expectation of good news continuing. For the long-term investor, the only differentiator is the fact that in spite of all this run-up, the broad market is still today trading at a valuation which is discount to its historical average. So from a valuation point of view, in spite of the run-up, you are still in fair value. You are not cheap as the beginning of 2012, but you are not expensive either.
Nilesh, so what explains mutual fund as well as DII's fraternity and why the sell figures every day, and more importantly, the complete lack of participation from the retail clientele?
The retail clientele, in a very commonsensical terms, are creating a barbell portfolio. So they are long real estate and gold, which has delivered great return over the last 5 years when equity has not delivered as good a return. So they are saying that let me take the risk on real estate, gold, and then let me solace safety in bank fixed deposits and tax-free bonds and so on and so forth. Clearly, Indian retail investors' behavior, if we see over many cycles in last 20 years, they seem to have entered into the market when the momentum is distinctly positive, and invariably they have made the top of the market in frenzy. The reason why I'm reasonably confident about the market is the fact that retail investors are underowning equity big time. And as long as they haven't entered into the market, the top of the market is far ahead of us.
Of late, a lot of smart money has moved into cyclicals. Do you think cyclical companies and cyclical stocks, they will be able to surprise in the second half of this calendar year with some kind of an earning uptick?
Potentially yes. However, you will still have to manage your portfolios on a overall basis. One can be overweight cyclicals, but my feeling is that in FY14 or CY13, some sort of pair anchoring will be better for your portfolio. So one pair anchoring is, generally it will be appropriate to be long export sector courtesy the weaker rupee rather than domestic sector. Second pair anchoring which will come handy is long private sector banks and non-banking financial services company vis-a-vis public sector bank, where NPA and margin could tilt in favor of the formers. The third anchoring which will come handy probably is related to long interest rate sensitive sectors vis-a-vis non-interest rate sensitive sectors, where courtesy the better liquidity and expected downward movement in interest rates will be beneficial to the interest rate sensitive sectors. The fourth thing will be related to cyclicals, where one will have to look at less debt-laden companies vis-a-vis high debt-laden companies, companies whose capacity is upstream and running versus companies whose capacities are going to come in future. So anchoring your portfolio on this kind of trends will be far better. The other anchoring which hasn't worked for almost last 2-3 years is long, lower P stocks having similar characteristics like pharma sector versus, underweight high P stocks like consumer staple, which also has a similar characteristics. So this kind of anchoring will be beneficial to the portfolio.
Nilesh, what's your expectation from what the RBI may do this time around? And more importantly, it seems like, the market is already pricing in a 25 basis cut on account of the commentary that we've seen from the Reserve Bank governor. So does it seem like this could be a buy on rumor, sell on news kind of event?
Definitely the fixed income market has rallied very fast in last 10 days or so. Yields have declined by about 30 basis points, and clearly that's far more than what is expected to be announced by RBI on 29th of Jan in form of policy rate direction. So clearly now what market will be looking forward is not just the rate cut action, but also the confidence emerging that this is just the first of the series and there will be more rate cuts in offering. If that kind of confidence doesn't get percolated to market, then we could see some amount of reversal in this interest rate market for a short period of time. So clearly market is not only looking forward to action on the policy rate side, but also some sort of guidance that this is first in the series and more will follow.
Nilesh, would you agree with my assessment that yes, strong numbers, they managed to beat the expectations, but it's too early to pop the bubbly?
I would just like to quote, what I have learned over markets over 2 decades. If you wait to buy a stock bereft of any uncertainty, then prices would have already discounted those certainty. You will have to buy stocks when there is some amount of uncertainty. Now certainly today you have mentioned correctly that this massive jump in prices because of short covering. There will be natural correction or moderation in prices over next couple of days, and that's the time to accumulate Infosys. Don't wait for all the certainties to emerge, because by then the stock would have moved up significantly. Look at the valuation, look at the management. Don't take 1 day, 2 day, 10-day call. Take 3-year, 5-year call. Anyway, the shareholding pattern of Infosys suggests that we have already sold this company to foreigners. It's one of the great Indian company, but unfortunately, we don't own enough of it.
Splendid answer, Nilesh. That's where we just love your wisdom. So, let's take your wisdom forward. At the current juncture, where to your mind there is deep value and lot of uncertainty, and progressively that uncertainty will only fade away?
I think this is more visible now in the infrastructure sector, where capacity additions, be it across roads, ports, power or telecom, will come under pressure. This is happening because of tight liquidity, higher interest rates. This is happening because of the limitation in terms of faster project execution. So all those companies whose projects are going to come up in distant future, don't worry about them, but focus on companies whose projects are already up and running, or whose projects are going to get commenced in very, very short period of time. This capacity from a replacement value point of view has already appreciated because of inflation. You could put up a power plant at 4 crore a megawatt few years back. Today it takes at about 7 crore a megawatt. So from a balance sheet point of view, you are in beneficial terms. From an earning point of view, the merchant power rates have started moving up. Deficit of power is visible to everyone. So all these services which is going to be sold in future will get priced at a higher level than what market is discounting. Just focus on the debt component of these companies. As long as they are less indebted, owning this portfolio of stock will be far more beneficial. This is where deep value lies.
And where to your mind things are priced to perfection and little bit of disappointment, we could see a strong unwinding or a strong adjustment? So we've looked at pockets of opportunity. What about pockets of froth?
The one pocket of froth, and it will be a slightly harsher term to call it, is consumer staple sector. I don't think there will be a price correction there because no supply emerges ever from that sector. In absence of supply emergence, we will see gradual derating of some of the IT companies which have delivered stellar performances over the last 5 years. Law of average has to catch up with them, and hence there will be no price correction. But in a booming market, in a market which is